Stanley. We are in conversation with the man himself, Ridham. Ridham, great having you. Thank you for talking to us.
Thank you, Neeraj. Great to be back on Bloomberg Quint.
Thank you. And Ridham, it's a pertinent time simply because there is lots happening. We're right in the middle of the year. And for you as well, it's been a long journey for Morgan Stanley in India, 24 years, and a lot of interest considering that the numbers are looking great, but there is also an upcoming election.
Yeah, of course, there is an upcoming election, and we get that every 5 years. So it's the hard one to crack. When there are 1 billion eligible voters, and I guess about 700 million will show up. They come from so many different backgrounds. It's so hard to tell what they will do as a cohort. And in the past, they have done things which have not necessarily been good for the economy. Because what is good for people at large may not be in sync with the economy. In the short run, these things can be at loggerheads. In the long run, they're all aligned, but in the short run, they can be at loggerheads. So yeah, we'll see what happens in 2024. Hopefully, the people of this country deliver another majority mandate, and that'll be good. That'll be good for the economy. It'll be good for the markets.
Yeah. So what is the participation like in this year's conference? Because when I was at Davos as well, India was on top of mind for almost everybody. So what's the participation? What is your central message at this conference? And you came out with a really interesting report 3 days back. So is that the showcase into what Morgan Stanley is trying to say?
So I think, so the conference has got about 250 investors, about 60 odd companies over 2 days, maybe around 1,600 meetings. So it's going to be a busy place. And yeah, we'll learn a lot about what investors are currently thinking about India. I do believe from the data as well as from the conversations I'm having that the view has inflected into the positive direction. The last 2 years, foreign investors have not been so constructive on India. One of probably the main reason has been, the main pushback has been that the market is too expensive. Now, I think finally there's a little bit of conviction coming back. India did underperform for a brief period between October and March. In April and May, it has caught up a lot of that year-to-date underperformance. In fact, that's gone down to zero. But the significant thing is that the earnings are coming in quite good, and the economy looks very strong. We've got multi-month highs on the PMI. So suddenly, I think investors are starting to believe something that we've been talking about for months, that this is a new profit cycle and profits will surprise on the upside. And when you get into a new profit cycle, at every point you look back and you say, oh God, stocks were cheap last year, because earnings, go forward. So I think we're in that type of a cycle where on a trailing basis, stocks may not look cheap enough, but on a forward basis, I think they will look actually quite attractive. The market is not oblivious to the profit cycle. It's just that the market cannot price all of it in. And if there is an upside surprise, then it's certainly not in the price.
Got it. Now, I'll come to earnings, but I want to mention a point here. I know you a lot of times tell me that, Neeraj, I don't get a lot of my predictions right. But hey, I'm thinking back to when you were the guest at the summit, right? This was in September, if I'm not wrong. And at that point of time, you mentioned that India looks expensive relative to Asia, so India may underperform, and it has. Now you are telling me that you believe that there's a profit cycle, and India may not necessarily be that expensive looking ahead. I'll read your note as well, and I think in one of the slides you guys have mentioned that there's a possibility of a re-rating too. So you're not getting it wrong in the last few times that I'm talking to you. I would love to understand how you think about the next 12 months.
So you're right. In September, I did highlight, and what was happening there was that in the trailing 3 months, the price momentum had been so strong on a relative basis that it was bound to peak at some point in time. That precise moment was actually first week of October last year. Then after that, we've come down very sharply actually on a relative basis. We lost everything that we had gained in 2022 in a matter of 4-5 months. So the market again started looking very attractive on a relative basis in March, which is what we highlighted to investors. We upgraded India as well. We downgraded in October, we upgraded in March. And today I think India is looking a lot better. One of the things that was in play last year in September, October was that the denominator, which is what we compare India against, which is the emerging markets, especially Korea, Taiwan, China, were looking quite interesting. Today, I think they're looking less interesting. at least relative to India, they're not looking as interesting as they were then. They're still very interesting. We're still overweight all those markets, but India is now also looking very interesting. And the primary reasons are the valuations have corrected on a relative basis, and the earnings cycle looks very strong compared to almost any other place on the planet. So this is a good place to be.
Interesting. You bring a lot of global comparisons. There are a lot of investors that have spoken, global investors that have spoken in the last 1 month, who say that when I look at the global picture, US is not rallied that much. Sure, the AI would have rallied, but otherwise, equal weight, the S&P 500 is largely flat this year, so there is a lot of scope there. In Asia, Japan looks a lot more attractive than anything else. So why India?
No, that's right. In fact, we are also very positive on Japan. We're less positive on the US. In fact, I think that's the market we are most bearish on on a relative context. So the pecking order is Japan, followed by Asia, followed by Europe, followed by America. So we're less constructive on US. Our US strategist thinks that the US is going to experience a pretty big downward draft in earnings, which he doesn't think is still priced. Japan is a little bit of a structural story, so there will be good returns. But India is, I think, offering something very different. I think India is offering compounding which may last for a few years. It's not a 12-month thing. In all these cases, we are making a 12-month view. In India, I'm making a multi-year view, plus a 12-month view. So the 12-month view looks positive. I think the market, unless something untoward happens in the next 6 months, is going to start pricing in a majority government as you approach the end of the year and go into early next year. So it's going to go really strong into the elections. And then if the election results come in line, you get a little bit of a correction in the stocks. And if it, of course, disappoints, then you get a very sharp correction. So it's reminiscent of 2004. Less relevant comparison is 2009. Another relevant comparison is 2014. In both 04 and 14, the market rallied hard before the elections, pricing in a strong election outcome. In 04, it got a negative surprise. In 14, the result was a little ahead of the market, but the market actually took a breather because it had already priced in a very good outcome. So I feel that, likewise in 2019, in 2024, I think we're probably going to see the market price this in 3-4 months ahead of the elections. Again, I'm saying this assuming that nothing untoward happens between now and then.
Yeah, sure. But also that while usually people talk about the world market start at the hip to the US, both economically and market-wise, I think your note also makes the point that India may decouple from a US recession, which is not the usual thing, if I'm not wrong.
It's already decoupled.
Right.
So if you look at the last 30 years data, every single US recession has produced a bear market in India. I don't think that's happening anymore. And it's down to a lot of heavy lifting we've done on policies. So it starts with inflation targeting, then the fact that we allowed retirement funds to invest in equities in 2015, what I call as the 401k moment for India, the focus on FDI, then a global factor which is China +1, the emergence of Indian consumer, because we have crossed that magical number of 2,300, 2,400 US dollars per capita income. We've now entered into a period where we become relevant as a consumer to multinational companies. So a confluence of those forces plus a lot of constructive policy action has brought us to this point. So that is how I think we are decoupling from both the US growth cycle, the US Fed cycle, and also oil prices. Okay, it's not that we don't import oil anymore, but we are less sensitive to the funding cycles of oil. So if you look back, and 2008 is a good example. In 2008, India was completely unconnected to the global financial crisis. Our banks were in great shape. We had nothing to do with it. Yet we finished that year as the second worst performing market in US dollar terms. And the only reason for that was that middle of the year, oil prices spiked to 140, 150 US dollars. At the time when we most needed foreign money, foreign investors sold India because oil prices went up. And we lost $20 billion of FPI flows in a matter of 6 months. And that proved very punitive for India's macro, because when we most needed the money, it went out. That's no longer the case because our oil deficit is no longer being funded by capital market flows. capital market flows are very sensitive to inflation data, very sensitive to interest rates, very sensitive to oil prices, and they do, this cyclical thing. FDI is a lot less sensitive. In fact, it's almost not sensitive at all. So it changes how India's balance sheet is behaving, and therefore it reduces India's correlation to oil as well. So all these global factors which used to be, sum total of this actually is that India's beta to EM used to be always more than 1. It's now 0.6. It's like a consumer staple stock in the EM universe. Very stable, steady, does very well during EM bear markets. Remember 2022? Doesn't do so well when EM rallies. Last quarter of 2022, first quarter of 23. And will start doing better as EM cools off, because again, that's how defensive stocks behave.
Yeah, that's interesting. Some people also make this argument that is no longer as cyclical a stock as well, and they cite the possibility of a rupee trade for crude, and if India is able to do that in a meaningful way with Russia, as well as then impress upon OPEC to do the same, then it really solves the CAD issue for good, so to say. Do you have any thoughts here?
No, see, the CAD issue, so first of all, we have to understand what is CAD. Okay, so the current account deficit is the excess of investment over saving. Okay, so that's how it is, and this definition is very important because people actually conflate this with other things. People come to the table saying, "Oh, if you run a current account surplus, it's very bullish." Okay, that's China has had a current account surplus for 15 years. The stock markets have gone nowhere. Yeah. Okay, so just by the virtue of having a surplus, you don't actually create prosperity in the stock markets. It is to do with how your saving pool moves. Because if your investment rate is declining, then the current account will go into surplus. Is that good? That's not good. Not good. If your investment rate is rising, but your saving is also simultaneously rising, then that's great for the economy, it's great for earnings. Now the saving can go up on account of two things. Either the country as a whole saves a lot more, but then ultimately, there is only 100 rupees on the table. If you save a lot, then you consume less, you create less demand. So the other way of generating saving is by, and this is the way India is now achieving it, is to improve terms of trade, which is you increase your trade with the world, you get better pricing for it. Okay, so your price of imports decline relative to your price of exports. So the fundamental change that's happened on the current account is not oil, it's services exports. Okay, so what has happened during COVID is that the typical multinational CEO learned that it's okay to work from home. Okay, not just multinational, in fact, all CEOs learned that it's okay to work from home. And if it's okay to work from home, then it's a whole lot better to work in Mumbai and Delhi than it is to work in Florida, because it's very cheap. And that's why a lot of jobs have got shipped to India. And they're still getting shipped. Mm-hmm. And that is creating, so this is not just IT, okay? So you may not see it in the IT revenues, because IT is only one part of this overall services revenue boom that we are witnessing. And we've still not come to tourism, okay? Because when that takes off, then you get even further lift on your services exports. So the fundamental shift on the current account, which is why I'm so constructive, is that you get this shift in your pricing basket. So your export pricing is getting a whole lot better than your import pricing. Certainly import pricing has improved because oil prices have gone down, because sunflower seed prices have gone down, fertilizer prices have gone down. But the fundamental structural shift is happening on services export. Now, if we can take this into goods, then we are going to be in a golden period. And that is what the government is trying to do. We have been a big failure in the past in creating any major appetite for Indian goods. And now we are seeing signs of that change. So if that happens, then I think we are in a situation where the economy will be in very good shape for the coming years.
Are there corporates in the conference which are trying to walk this rope of exporting the large goods into the rest of the world? Because we've seen that in electronics, but not necessarily everywhere else.
So see, Neeraj, it's actually right now happening in very basic stuff. It's happening in chemicals, it's happening in auto ancillaries, it's happening in leather goods, it's happening in clothing. This is very simple stuff where India already has existing capacity, where it is already competitive, but it's not scaled up. Now, when I converse with some of the companies in these sectors, the thing that I learn is that the order books, the export orders are getting much larger than in the past. So there is some supply chain shift that has happened. It is still small in overall context, but it's pretty significant at the margin.
Sure.
And that I think will continue to scale up. Electronics will add on to it, and some of the new sectors will come on top of this. But the basic stuff that we do for a living, we need to wear our shoes, we need to wear our clothes, we need the chemicals, we need the auto parts. I think India is already good at doing all this. It's just that it has never scaled up because we were not competitive. So one of the things that we have researched a few months ago was on the cost of doing business in India. And we compare this with many other countries with whom India competes. When in 2019, the government lowered tax rates for corporates, it took away one of the biggest cost elements in doing business. And today we are cheaper than a lot of these countries. On top of it, we have a market which is very attractive, and we have the size to absorb FDI at scale. So people talk about Vietnam, as a competitor. Vietnam is a $500 billion economy. It cannot take $1 trillion of investments in. India is, nearing up to $4 trillion. $1 trillion, not a problem. We can absorb it. So if you're doing small scale stuff, it's okay. But if you want to now take it to the next level, there are very few places on the planet that can absorb investments like India can. And the good news is, again, it goes back to government policy, is we've spent a lot of the last 7, 8, 9 years building infrastructure. And there has been a meaningful shift in the cost of moving things around. So the transit time on roads, the transit time at ports, everything has fallen. And the inventory that used to be stuck on Indian roads was a very high cost of doing business. That inventory is progressively falling. In the next 3 years, it will fall dramatically. India will be at par with most of these Asian countries in terms of infrastructure costs. And then our labor is still cheap compared to all of them. I mean, Chinese labor costs have gone up through the roof. India is still cheap, and India still has, unlike China, where population is declining, India still has a constant supply of new labor. So I think it is quite, I have to keep pinching myself because it's looking so attractive, and I have to be sure that, I'm not getting carried away.
Yeah, most certainly. You've spoken at various times about how starting 2023 onwards, we see banner FDI flows coming in. We've seen the headline numbers coming in. There's an Apple, Foxconn, so on and so forth, etc. But the data that has come in also seems to suggest that starting from 2021 to 22 and 22 to 23, there's been a decline there. How do you explain this dichotomy, and what's your view about what happens ahead?
So I think it's largely to do with the difficulties around COVID. So a lot of global supply chains got disrupted, and therefore it was very hard to move things around. Shipping costs went up. So I think that's hurt some of this FDI flow. It should normalize now. We're out of COVID. We should see better FDI. The other thing is that this FDI number includes VC funding. That market really crashed last year. So we were at a run rate of about $50 billion US. It fell, at the beginning of this year to 3 billion. So that is what drags down the overall FDI number, because that VC funding, this is, startup funding for internet companies, is part of the FDI. So it is not necessarily for manufacturing. So that is, something we have to keep in mind when we evaluate the FDI numbers.
Got it. Now, if you have to pinch yourself to try and stay sane with regards to the bullishness that you have within you for India at large, it would be as difficult to try and think about what will propel this higher, because there's just a bunch of promising thing out there. So when your top investors ask you about where is Ridhamdesai advocating the biggest bucks to get invested into, what is your answer?
So from a 12-month perspective, because that's generally what the horizon of institutional investors is, it does look like that non-bank lenders will have a very sweet time. Interest rates in our view have peaked. Inflation has peaked. So this is going to be a year in which interest rates remain flat. Last year, they had a really difficult time because the wholesale lenders need to borrow continuously, and they were experiencing a sharp rise in their cost of borrowing. The banks actually don't experience that instantaneously because the average maturity of deposits is a year. So it's only after a year that they start seeing that cost. So for them it will happen now. For the wholesale lenders, the cost will stabilize, the margins will improve, and I think loan growth across all these businesses will remain strong. So I think the wholesale lenders would be my top pick. And the other area I think is discretionary consumption. I think we should see very strong trends there. I expect a pretty smart recovery in rural India. The only caveat there is the weather, but unless it's really atrocious and we have a 15% shortfall in rainfall, I think we should be okay. 5-7% I don't think will create a problem, but a 15% could create some problem with rural demand. Otherwise, I think so. I'm willing to take a chance with that. I think going by all the weather forecasts, it looks like we'll have a tough monsoon, but it's not going to be a terrible one. And I think rural will do well. So discretionary consumption. And then I think industrials continue to do their thing because the capex cycle is picking up and they will also, I think, do very well. And you can see that in the earnings numbers. What people sometimes miss is the operating leverage that exists in some of these businesses. So a little bit of a tick up in revenues and profits actually go up a lot. The one theme I think we're dealing with in F24 is a margin recovery theme. So I think that's a pretty good theme. There's going to be margin recovery across many sectors, and therefore I think profits will surprise on the upside.
Yeah, well, that's positive. So and this is what is represented at the conference as well, I presume. I heard you say that there are 60 companies, 1,600 meetings. That's the kind of representation of corporate India.
We have a lot of other companies as well from other sectors. So we have from IT, we have from energy, we have from materials. I mean, all the sectors are represented.
Yeah, no, I was just wondering the larger representation is probably around that because people would want to hear what you guys are the most constructive on. So that's what I'm trying to figure.
No, not necessarily.
Not necessarily.
No, we try to balance it because we could be wrong.
Yeah, that's true. Okay, just last couple of questions. Beyond 12 months, because there is so much that is happening which is multi-year. I hear, I mean, 2 days ago, I was talking to a wind power company which is talking about how the space is coming out of ashes and has a decade of great run ahead. Textile companies are talking about finally, great run post H2, restocking. This whole per capita thing that you spoke about probably has a multi-year legs to it. Where is it that you are very constructive on, where you believe you can see like a few years out?
So Neeraj, I think India has got a very strong growth path for the next 4-5 years with very strong earnings because profits will gain share in GDP. So I think overall we should see a pretty good environment for stocks until they get very expensive, which they are not right now. So we are okay. Now in that, if you do it by market cap cohort, I think the biggest, the most juicy stuff is in the mid and small cap space because that's the thing that does very well when the markets do very well. And so that's where I think that's one way of cutting the market. The other way of looking at it is from a sectoral perspective. So I think financials will still lead the way. Because our forecast is that we'll probably get about 17% compounded annual growth rate in loans. India's private sector credit to GDP is in the high 50s. And that's pretty low. That number may gallop by, a multiples of 10 percentage points over the next 10 years and could go past a 3-digit level, which if you use 10% nominal growth, GDP growth, you'll arrive at a pretty strong teen number for credit growth. And that means financial services, I think, will do very well. So that's one sector. Consumption is the reason why a lot of multinational companies are flocking here. So obviously that's a place you want to be in. And industrials are more cyclical, but I think the next 3-4 years should augur very well for them. You can see that in the commentary of a lot of multinational companies who are, raising their position in India because India has got the order book.
Yeah.
There aren't that many places on the planet which has got an order book like India has. So again, I think industrials do well. So if you see, it's not out of sync with my 12-month view.
Sure.
Yeah. But you add stuff like cement to this because I think cement benefits. I think that should be a sector that should do well. I think globally, the global facing sectors will likely underperform. They may still do okay on an absolute basis, they'll likely underperform with the possible exception of IT services. And IT services, I think, is maybe goes through a little bit of a soft spot and then comes out. But the key debate there is what happens with AI. And I think everybody's trying to understand that. My own very primitive view is that the initial AI burst will actually be very positive, because somebody has to write the code, and nobody does it better and cheaper than Indian engineers. So we'll actually see a acceleration in growth. So let's see how that pans out.
Okay, my final question, and that is on something that at least I believe you look at very closely when it comes to India valuations, and the factor is ROEs. And I thought I saw in the note that you've written that after a period of a downtick for Indian ROEs, we are now headed higher. Is that a telling factor when it comes to valuing India vis-a-vis rest of the world?
Yeah, absolutely. So India has always enjoyed a premium return on equity to emerging markets, except during the 2 years of COVID when India's ROE actually dropped to EM levels. And now we are gapping higher. So that's the reason why India trades at premium valuations. The other reason, which is technical, is that we are in this great run of domestic household balance sheets shifting allocation towards equity. So equities are gaining share. Even after all of this, equities are still going to be single digit compared to gold, which is double digit, and compared to property, which is at 50%. So equities still have a lot of headroom in terms of allocation. And incrementally, I think they will continue to gain share in the household saving allocation. So that, combined with the fact that we have strong earnings, which basically means a good ROE also, I think means that India will command these premium valuations. Those valuations, the premium has expanded, and I think we'll probably continue to command that in the foreseeable future.
Okay, well, have a great conference.